This is The Wealth Puzzle with Michael Mansfield from the Lynn Group. When a part of your financial strategy is out of tune, your long-term goals, your retirement savings, and your legacy can all suffer. With many years of experience in the financial industry, Michael provides his clients and prospects with the information they need regarding Social Security, retirement income planning, wealth management, and much more. Listen in as we address your financial concerns and provide helpful solutions to put you on the path to achieving your retirement goals. And now, here is The Wealth Puzzle with Michael Mansfield.
Howdy, everybody. Thanks for tuning in. I'm Mike Mansfield with the Lynn Group. Wanted to circle back. I know it's been a few weeks, but obviously so much going on in the headline news and the economic news and political news. Holy guacamole. It's just a storm of information lately. But things are good here. Things are good at the Lynn Group. We're just staying busy. We're excited for Thanksgiving next week. It is Thursday. I waited till Thursday because we've got to talk about NVIDIA earnings and some exciting things like that. But first and foremost, the world is crashing. The end is near. This was the headline that came out a week ago. Foreclosures jumped 20%. Distress in the market. The housing crash coming. I fielded a few phone calls actually about this specifically. And I thought it was interesting because it is almost playing into perhaps some of the bigger challenges of media and data and information. But basically what it's saying is, hey, year over year, looking at October's, foreclosures jumped 20%. That sounds dramatic. All of a sudden, we all have PTSD going back to 2008, the mortgage crisis, and this is it. We've been hearing about it for a year that the recession is coming, that the stock market's going to crash, that the end is near, and these things are only adding to now that deeper anxiety. What's fascinating about it is, yes, this is true. Technically, October to October, year over year, foreclosures are up 20%. The problem is that's not giving you all very good perspective. And so if we go literally to the federal government's website, Federal Reserve Bank of St. Louis, FRED, so everybody has access to this. Here it is. Here's foreclosure delinquency rates on mortgages all the way back to 1990. Now, everybody remembers right in the middle. So in 2008, mortgages started, foreclosures started to skyrocket. This caused the mortgage crisis. But does anybody notice this chart if we're looking at it over the course of 40 years? What are we seeing here? Oh, we're noticing that, yes, year over year, foreclosures are up, but they're actually sitting at one of the most historically low points ever in the last 40 years. We had a flat spot back here in 2004, but this is very low. We have a very low rate of actual real foreclosures. So anyone who's hyperbolic thinking the housing market is about to crash, that is just factually inaccurate. It is not happening. There's nothing leading up to the 2008 crisis. You go back to 2008 and you look at some of that stuff. There was 3 million distressed properties on the market, I think in 2012 and 11. That's where housing prices really bottomed out. Last year, only 4 million total houses sold in the U.S. We have a supply side issue. That's why year over year, real estate values are still up 2% in the last year. So if delinquencies and foreclosures were increasing, we would think that prices would be dramatically falling everywhere. What's really happening is we're having isolated areas of delinquency. For example, the largest foreclosure delinquency area is actually Florida right now. But as we recall, remember COVID, everyone rushed to Florida. They overpaid, they fought for real estate values, and then some storms hit. And now your homeowner's insurance is so expensive there that's where they're having some mortgage trouble for the most part. But in totality, very low risk of a housing market correction. And once again, seeing these headlines, I even saw it when it first came out. I was like, uh-oh, is this, one more straw on the camel's back? But when you dig into the data, you realize that actually the housing market is very stable. One of the things that's playing into that, guys, is when you look at mortgage rates, there are so many mortgages in the 2 to 3 range, the 3 to 4% range. Something like 75% of mortgages are below 5%. People are well capitalized on their mortgages. Real estate values came up, so nobody's underwater on their homes anymore. People are maintaining those mortgages. So the housing market is actually very stable. If anything, we just have the continued problem that we've had forever. And that is that we have an underbuilding issue that actually started back in the good old days in the '08 mortgage crisis. Builders started underbuilding. They haven't really caught up since. And, and that's what the real problem is. All right, fast forward. I waited till today because we wanted NVIDIA earnings. So NVIDIA earnings obviously represent a big piece of the let's find a website so I can show you a visual. See, I'm impromptu. So here's a heat map, but this shows the size of companies in the S&P 500. Anybody who walks in my office, you see this all the time. But you notice NVIDIA, this big giant square on the left here. If you look at it in the peering of all these 500 squares, you'll notice it's the biggest. It's almost a $5 trillion company, which is pretty wild, insane. If anybody who is letting us help them with their assets, you know that we've actually recently trimmed our NVIDIA holdings last month when it hit $5 trillion, and it has since pulled back. But the market was sitting on edge for the last 3 days, right? The market's been going down for the last week. It's been flat for the last month since the beginning of October. There's a lot of layers to the reason for that. Certainly one was the shutdown, the lack of economic data, the concern that the Federal Reserve wasn't going to cut interest rates in December, which I'll touch on in a second. And then just the anxiety. There's been this talk about an AI bubble. Are AI companies spending? Are they building? Are they generating revenues and profits? And so everybody was sitting at the edge of their desk waiting yesterday for these earnings to come out. And they come out and they're pretty impressive. They beat earnings, they beat revenue, they beat everything. The guy says, what's the problem? We're making bajillions of dollars. Hot diggity dog. So you can kind of see here on the chart. It's hard to see here on the little side, but NVIDIA right here has just popped straight up right here today and is cycling back up. That puts a positive tilt on the general market. I'm sitting here, the Dow's up 500 points right now. So the market's in a good mood all of a sudden the AI bubble, all of a sudden the fears, all of a sudden the anxiety. Everybody's like, just kidding. Here's the S&P 500 over the last year. Kind of the same exercise of what I was talking about is you see this kind of flat spot right here. Yes, we've got some ups and we've got some downs. Whoops. But it's really just gone sideways for the last month. So once again, that was earnings were coming out. You had the shutdown, so we're lacking some economic data to get some definitive thought on the Federal Reserve. Once again, big companies talking about AI bubbles, things like that. Well, we just got past the NVIDIA earnings, so that does help the cause. What about the Federal Reserve? So the Federal Reserve meets on December 10th. All of the sudden, this left bar here that says 39.6%, all of a sudden there's a basically 40% chance the Fed's going to do a quarter point cut. To put that in perspective, I know it's kind of hard to see here, is if you look down on this lower bar all the way to the far right, a month ago, there was a 99% chance the Feds were going to cut. It's gone from 99% to 40%. Obviously, the probabilities of the Feds cutting has come down a lot. That has kind of stymied the market a little bit because remember, the market was pricing in a month ago the guaranteed idea that the Feds were cutting. That was already in the data. That was already in the books. So that's kind of pouted out the market a little bit because let's all be honest with ourselves. Us Americans are very addicted to our cheap, free, easy money. And the Fed said they're going to cut. The Fed said they're going to print money. That makes the world go round. It speeds up the velocity of money. It speeds up the velocity of spending. Ultimately, ironically, it creates inflation. Those are secondary issues to talk about perhaps. But the concern is, what's the Fed going to do next month? A lot of this decline in the probability of them cutting was about the failure to get data. But we're going to get some data between now and then anyways. So we'll see how that shapes up. Now, doesn't mean the Feds are done cutting just because December is looking a little pouty based on the shutdown. You go out, a few months. You'll go out to the April meeting. There's a 90% probability the Feds have cut, and there's even a small probability they've cut a full 1% by then. It's very probable over the next few months the Feds are cutting interest rates, which once again lends to the idea of velocity of money speeding up, leads to the idea of quantitative easing, that's money printing, once again speeding up the stock market, increasing home values. That stuff doesn't happen instantly. It certainly happens over time. So there's a lot going on here. So, the argument is we probably have a lot of conviction that we do see the stock market cycle up, certainly in the near term. Earnings are coming out. Earnings are stable. the Federal Reserve is cooperating with the stock market. Even going back to the theme of a bubble, the bubble that we talked about last was the dot-com bubble of the 2000s. Well, the funny thing about that bubble is that what popped that bubble was not necessarily the valuations. It was not necessarily the companies. It was that the Federal Reserve started raising interest rates and they dried up all the liquidity in the general market. That popped the bubble. So when we go to an environment that even if we were in a bubble and the Fed is now cutting and printing, if anything, they're going to make the bubble bigger if that was the case. So not a lot of concern about the bubble popping at the immediate moment. But that's a theme that we'll continue to discuss moving forward. Separately, as I've touched on in previous videos, the government is cutting regulations. That's a huge tailwind to the stock market, something to look out for in the first quarter of earnings. And so, I think there's a lot of positives here. Obviously, a lot of anxiety, a lot of stress, a lot of things going on. But all in all, we're kind of happy with where things are sitting at the moment. If you guys have any questions, thoughts, concerns, curiosities, please reach out to us. Certainly visit our main website, thelindgroup.com. But we're all here. We're all ready to help you guys. Otherwise, thanks for tuning in. I'll definitely be more active with making some more videos. I just started bugging Tana and Owen to get them on the horn here too, making some videos. So we should be getting more content and data out to you guys to keep you up with the current events. Talk soon.